Hi, I'm Lindy Newton and I manage Fixed Income Investor Relations. Welcome to our second virtual credit update. I hope you're safe and healthy and we look forward to catching up in person again soon. We've just announced our half-year results and having made good progress over 2.5 years on our simpler, better bank strategy, we've also refreshed our strategy. We've set a more ambitious agenda of building tomorrow's bank today for our customers. We have 4 strategic priorities. These include leadership in Australia's recovery and transition, reimagined products and services, global best digital experiences and technology, and simpler, better foundations. You can find more details on the Investor Centre of our website, including a message from our CEO, Matt Comyn. In this 10-minute video, the Treasury team will give you an update on our strong capital position and resilient balance sheet settings, our wholesale funding activities, and our credit exposures.
I'm Terry Winder, Group Treasurer for the Commonwealth Bank. After a challenging period for many people, we're starting to see a market turnaround and improvement in economic conditions in Australia. This is the result of very effective management of the pandemic and very significant stimulus packages from the government, monetary supply settings from the Reserve Bank, and various other business support packages, including the bank's loan repayment deferrals. The Commonwealth Bank has been very focused on making sure we're continuing to support our customers and communities. And we've been focused on strong operational execution, which has seen us deliver above system volume growth in all of our core businesses. Our balance sheet is the strongest it's ever been. We've taken a cautious approach to provisioning and we have a significant capital surplus. We want to maintain our strong balance sheet settings to withstand a range of economic scenarios. We're monitoring our lending portfolios closely, especially as stimulus and support measures are expected to taper at the end of this current quarter. We've announced an interim dividend of $1.50 per share, which is substantially higher than the prior period dividend. While we're facing a period of low interest rates and economic uncertainty from the impact of COVID-19, on balance we think there are reasons to be cautiously optimistic. The RBA is forecasting 4% GDP growth this year. Unemployment peaked at 7.5% in July last year. It was 6.6% by the end of 2020 and it's expected to keep falling. House prices are rising and the outlook is for that to continue, supported by low borrowing costs and higher savings balances. Australia also has a strong pipeline of infrastructure spend and consumer confidence is high. We'll be maintaining our strong operational focus and looking to execute a more ambitious agenda for the future.
Hello, I'm Kylie Robb and I'm Head of Funding and Liquidity. As Terry mentioned, the strength of our balance sheet was a key highlight of this result, and it means we're well prepared for a range of economic outcomes. Our reported CET1 ratio was 12.6% at the half, or close to 13% on a pro forma basis, after taking into account the expected uplift from announced divestments. This capital ratio incorporates the payment of our final dividend. The ratio translates to 18.7% on an internationally comparable basis, and it makes CBA one of the highest capitalised large banks in the world. The Australian government's fiscal stimulus in response to COVID-19 was one of the largest globally relative to GDP and has been very successful in getting money into our customers' bank accounts. As such, we've seen an increase in the proportion of our funding from customer deposits from 55% in 2008 to 75%. And our strong deposit growth sees us having the highest absolute and percentage level of household deposits in Australia. The government has also provided banks with substantial balance sheet support. This includes the Reserve Bank's 3-year Term Funding Facility, or TFF, to support low-cost lending to customers. We've drawn down our initial TFF allowance of $19 billion and have access to an additional and a supplementary allowance of around $20 billion at 10 basis points fixed until June 30, depending on business loan growth. At this point, we intend to make full use of this facility. As a result of the high customer deposits and TFF, we had strong liquidity through the period and have intentionally reduced wholesale funding. Our liquidity coverage ratio and net stable funding ratio are both well above regulatory minimums. We are comfortable with our long-term portfolio WAM of 5.2 years and have started planning for the TFF refinancing in 3 years. We'll remain focused on maintaining these strong balance sheet metrics.
Hi, I'm Fergus Blackstock and I'm Head of Term Funding. Even before the onset of COVID-19, our term funding issuance requirement had been lower for a number of years, as balance sheet growth was increasingly funded by high quality deposits and credit growth had generally slowed. In FY21, we're continuing to see strong deposit growth, and this likely means less wholesale funding, especially senior issuance. We have full year maturities of $21 billion. We issued $2.1 billion of new funding during the first half. This was made up entirely of Tier 2 transactions as we continue to work towards our TLAC compliance task. We issued a benchmark $1.4 billion 10-call 5 Tier 2 transaction in the Australian market, and we really appreciate the support we received on that trade. We priced $675 million in Tier 2 private placements across 20 and 30-year tranches. We also refinanced an Australian dollar securitisation deal to avoid margin step-up and bought back some term debt to help manage excess liquidity. Our existing Tier 2 capital now stands at 3.9% compared to the 5% required by the 1st of January 2024. We have $6 billion of maturities before the compliance deadline. We aim to continue building towards our requirement over time, ensuring we take into consideration prevailing market conditions. We expect to issue $4 to $5 billion of Tier 2 in FY21. We'll consider a range of currencies and tenors in Tier 2 to optimise our maturity profile, cost and investor participation. We remain open to reverse inquiries from time to time when we're clean from a disclosure perspective and reflecting a lower overall funding requirement. Our current debt portfolio mix remains balanced in terms of currency, with a skew to Australian dollars driven by the term funding facility. Our portfolio also remains well diversified by product. While senior debt remains our largest source of term funding, this will reduce over time in line with the increase in Tier 2 funding. For covered bonds, we have historically looked to maintain around 50% of our capacity limit, although issuance will be driven by our overall funding task in the near term.
We've further increased our forward-looking adjustments to collective provisioning of specific business sector exposures. As a result, our loan loss rate was 22 basis points of average gross loans and acceptances for the half, which is higher than pre-COVID levels. We've taken a careful approach to provisioning, notwithstanding the improved economic conditions in Australia. Our provision of $6.8 billion is $1.8 billion above our central case, which retains cautious assumptions and is more conservative than the RBA's baseline forecasts. Our provision coverage is now 1.81% of credit risk-weighted assets. As part of our COVID-19 support package and APRA's relief measures, we offered loan repayment deferrals to our customers. At the end of January 2021, less than 2% of our home loan customers and less than 0.5% of our business customers remained on deferral. This is down from peaks of 11% and 28% respectively. The majority of our deferral customers who have exited this support package don't require any further assistance. Consumer arrears rates have trended lower but remain insulated by COVID-19 support packages and government stimulus. We would expect to see these increase in the second half of this financial year as these measures are tapered. You can find the usual detail of our credit exposures by sector online, including a deeper dive of some of the sectors in shading. This busy slide is page 39 of our fixed income presentation. We've provided additional information this period regarding our provisioning against each sector. The 3 sectors we're monitoring most closely are highlighted on the screen. The transport and storage sector includes aviation and airport exposures, which continue to be heavily impacted by extended travel restrictions. We've increased our provisioning here and taken further impairments to the carrying value of the aircraft that we lease out. Entertainment, leisure and tourism includes businesses impacted by travel restrictions, shutdowns and social distancing measures. We're closely monitoring this diverse portfolio. For commercial property, we're focused on certain subsectors that may experience changing behaviours over time, for example, office buildings and student accommodation. Notwithstanding the improved macroeconomic outlook, the uncertainty and insulation from support measures suggests it's too early to be releasing provisions. So we've maintained a careful approach while we closely monitor our portfolios. Thanks for taking time to view our virtual credit update. I hope you can see that our position of strength puts us in a unique position to respond to the rapidly changing operating context while continuing to support our customers, contribute meaningfully to the community and deliver business performance. Please reach out directly if you have any specific questions or you would like to engage with the Treasury team. We really appreciate your support and we hope you're staying safe.